I've been trading the opening range breakout strategy for a few months now, and it's been working pretty well. But from time to time, the trade will hit my take profit target, like it did on this day, and then continue going without me. I want to be able to capture more of these moves, so I'm going to test out a trailing stop loss. This was suggested in a comment on my previous video, so I appreciate that tip. I do try to test things out when viewers suggest it, so if you have an idea, then leave it in the comments below. But first, let me quickly recap the strategy for anyone new to the channel. I will use this trade as an example, but first let me just mention that this is not trading advice, I'm not a financial advisor, these are just some of my own trades and backtests. The strategy is an opening range breakout, so it's a morning breakout strategy, and I'm using it on the 15-minute chart. So the first thing to do is just to make sure the time frame is set correctly to 15 minutes. I also need to be in the correct time zone. So in TradingView, in the bottom right, I set my time zone to New York. And then I look for the 9:30 candle, which is this green candle here. So let me get rid of this box just to show it more clearly. That green candle is the 9:30 candle. And the reason that's important is because that's when the US market opens. So I'm looking to see what will happen at the start of this trading session. Specifically, I'm only interested in what happens in the first 15 minutes. So I wait for this candle to close, which will happen at 9:45. And then I mark the low and I mark the high. That gives me the opening range. Once I have those, I sit and wait for a breakout with confirmation. What I mean by that is the price needs to break through this upper range and then it needs to close above it. So if we take a look at these two candles here, the first candle did break through the range, but then it came down and closed back below. So there's a wick, but it doesn't count as a breakout. The candle after that is the one that broke through and then closed above the upper range. So that gives me my entry signal and I buy at the open of the next candle. So somewhere around here. The stop loss is then set at the bottom of the range. So if I just put in a trade here, I'll drag the stop loss down and then I aim for a 1.5 to 1 take profit ratio. So if I drag this out, then we see we've got a winning trade closing on this green candle up here. Now this is a nice profitable trade, so there's nothing really wrong with it, but if I zoom out and just look further to the right, the trade continued quite a bit further. So even though I took a profit on it, there was quite a lot more that I could have potentially had. And I know that 1.5 times is quite a conservative take profit ratio. A lot of people will suggest taking 2 to 1 or even 3 to 1 and above. And that's fine, I have tested that with this strategy. But generally what I found is that yes, per trade, if I aim for a higher take profit, I do get bigger wins on those winners, but the overall win rate decreases. So for me, actually 1.5 times to 1 seemed to be the sweet spot. In that case, rather than increasing the take profit, what I'm actually going to do is get rid of it entirely. And instead, I'm going to move my stop loss up as the trade moves in my direction. I will still keep a mental note of where my 1.5 times take profit level is, but I'm not actually going to close the trade. Instead, when the trade reaches that level, that's when I'll begin moving up my stop. The stop loss will be calculated based on the ATR indicator, which is the average true range. The reason I like this indicator for stop losses is that it takes into account price volatility. So when price is moving up and down a lot, this ATR indicator is going to reflect that and it will increase with it. But if price action is slow and the candles are smaller like they are here, you notice that the ATR starts to decrease. This will give me a more dynamic stop loss. So if price moves really quickly, then the ATR will increase and my stop loss will give more room for my trade to breathe. I'll stick with this trade as the example. So when the price reaches this point up here and it hits my take profit, normally I would close the trade. But what I'm going to do instead in this modified strategy is activate the trailing stop loss at this level. So I'm going to mark this level here. That is where the trailing stop loss will be activated. And I will get rid of this existing trade just to avoid confusing things. So if I zoom in a little bit, this is now where I'm going to be working with a trailing stop loss. And what will happen is at the end of every candle, so when this candle closes up here, I will look at that close price and I will subtract the ATR, which I can see in the bottom left. So at this point, the ATR is 4.8. And if I just put a dummy trade on the close price from here, and then drag it up to give me 4.8 stop loss, that's somewhere around here. So that is now the new trade. And then every candle after that, I reevaluate the stop loss. So the next candle is a red one. It goes against me. At this point, the ATR is 4.7, so it's almost the same as the previous candle. And just visually, we can see that the stop loss, if I was to recalculate it, should move below where my current level is. But this is the important thing about trailing stop loss, is that it should never move backwards. It should only ever move upwards. So once I have my stop loss set here, even though the next candle moves down against me, I'm not going to be moving this stop loss away downwards. Instead, if the candle and the price goes against me, well, that's fine. The trailing stop loss is activated and I exit the trade. But I have to always remember that golden rule of always moving the trailing stop loss in the direction of my trade, never moving it against the trade. So that means that on the red candle, I don't do anything. And then we have another green candle afterwards. So let me move this position to the new candle up here. Now here, the ATR is 4.9. So if I shift this up to 4.9 stop loss, so that tightens up the stop loss a little bit more. I would then move through each of the subsequent candles, recalculating the stop loss. But it looks like eventually on this red candle here, I get stopped out of that trade. That's not too different to the level I had for my take profit. In fact, it's maybe a little bit less. So on this particular trade, I would have made more if I just stuck with my original take profit. However, here I'm using pretty simple rules of 1 times ATR for the stop loss. But there's a lot of flexibility here. If I use 1.5 times ATR or 2 times ATR, then the stop loss becomes a little bit wider. And that does two things. One, it gives the trade more room to breathe. So with this kind of ATR stop, I actually could capture quite a lot more of the move. But the downside is that it's not as tight, meaning the price will then retrace quite a bit before stopping me out. So that gives me quite a few variables to work with. First of all, I have the trailing stop loss, which can be activated at my original 1.5 times take profit, or it can be activated at different levels. And secondly, once I'm in the trade, I can have different size of ATR stop. So I'm going to backtest all of these variables to find out what works and what doesn't. I jumped over into my code, updated all of the backtest from my original opening range breakout strategy, and I added in this trailing stop loss. And when I reran the strategy code, this is the output that I got. The backtest runs over the last 5 years. It starts with a balance of 100, and then it finishes up with about 2,500. So there's significant growth over that time, and this is a much better result than what I got with just a fixed 1.5 times take profit. I then tested out the different take profit levels, at which point I activate the trailing stop loss. So for example, this blue line here is a take profit of 1. So as soon as the trade hits that 1-to-1 level, I start to trail the stop loss. And that's where the blue line ends up. All of the equity curves come out profitable, however, the purple one is by far the best. And purple is the 1.5 times take profit. So the original setting that I had on it does seem to work the best, and that's the one I'm going to stick with. I then repeated the exercise using the 1.5 times take profit, but this time the variable that I changed was my ATR multiplier. And I tested from 0.5 times ATR for the stop loss up to 2 times ATR. And what I noticed is, again, all 4 of the tests showed good results, and they actually followed a similar trajectory. The yellow and the orange performed pretty much the same. So yellow is the 0.5 times ATR and orange is 2 times. I guess they underperformed because they either choke the trade out, as with the 0.5 times, or give back too much profit as the 2 times ATR. The purple line was second best, and that was a multiplier of 1.5 times. And the best result was the blue line, which is 1 times ATR. So what my backtests tell me is that the 1.5 times take profit with a 1 times ATR trailing stop is the best configuration. And although that didn't make much difference on the example that I just looked at, and the trade ended up closing in a similar place to the original fixed take profit, the backtest showed that over the long term, my strategy performs better with that trailing stop as opposed to a fixed stop. And finally, I reran it with those optimal settings to see what the overall metrics are. The starting balance was 100 and it finished up at 2,436, which gave an annual return of 82.5%. And that was done with a drawdown of about 28%. The win rate is about 47%, so it's not hugely different, but the average reward to the risk has increased from my fixed 1.5 times to 1.63. There is a downside to using a trailing stop, which is that I'll always be giving away some profit, since the price has to come back from a high to hit that stop loss. But that's just a trade-off with removing a hard take profit level. This also only really works when there's a clear trend. In choppy conditions, a fixed take profit would be better, but the S&P 500 is something that over the long term has trended upwards, which I guess is why the backtest showed better performance for this trailing stop loss. Another idea that I want to test out is to compare the different opening range timeframes to see how they compare to the 15-minute that I use. Make sure to subscribe to get notified when I upload that video. Thanks for watching, and I'll see you in the next one.